All right, here's the last piece, part three of our pre-work here. So there's three transactions on question three, and again, we need to remember in the equity section is where you have your revenues and expenses. And in order to have revenue, we need to make sure we deliver a service. In order to have an expense, we need to make sure we use up some kind of resource. Let's look at this thing here. One of the corporate clients from transaction G paid their bill by giving us $4,000 cash. Transaction G was on question 2, and that was the one where we did $6,000 worth of work for our clients. And if you remember that transaction, we earned the revenue back there in transaction G. We earned $6,000 in revenue because that's when we delivered the services to our client. But our client did not pay us, right? But here, now fast forward to this transaction J, client just paid us $4,000 cash. First question you always want to ask is, did our bank account go up or down? And our bank account did go up or down, so we're going to increase our cash account by $4,000. But the next question you want to ask is, did we provide a service? We collected some cash. Did we do any work here? And the answer is no. We did the work like before on this transaction, and we recorded the revenue then. So there's no revenue here, right? No revenue over here in this equity section. Nothing to record here. What did happen? Well, our clients paid us some cash. When your clients pay you cash, what happens to the amount that your clients owe you? And the answer to that question is the amount that your clients owe you goes down. If somebody pays you cash, the amount they owe you ends up going down. And what is the account that records the amount that your customers owe you? Think about it for a second. I'm going to write it in a second, but think about it. What is the amount? What is the account for amounts customers owe us? It is accounts receivable. And that amount that they owe is going down by that amount they paid, by the $4,000. So if you think about it also, now remember, this is the change in accounts receivable. When you're doing these transactions, it's changes. So the accounts receivable goes down by $4,000. Our customers used to owe us $6,000 back on transaction G. Remember, accounts receivable went up $6,000 there? Now at this point in time, the balance in accounts receivable is $2,000. Right? There's $2,000 remaining that is owed to us. But the change here was that the account went down. Put a little negative sign there by $4,000. Right, so let's look at this one's a similar one on letter K, but it's just on the other direction. We're ASI, we pay $250 to our supplier for the supplies purchased in letter D. So if you remember in letter D, we bought $400 worth of supplies, but we did not pay the supplier at that point. And if you also remember on letter D then, you may want to look at your notes for that or go back to question 1. You'll see that our accounts payable liability went up by $400 on letter D because we owed $400 more. Well, what did we do here? We paid $250. Anything happen to your bank account when you pay money? Yeah, let's get that one out of the way. That's the easy part, right? $250 going down in cash. Easy part. Well, how about now? How much money do you owe your supplier? How much money do we owe at this point? We used to owe $400. Do we owe less? And yes, the answer is yes. What's the account that represents the amount we owe to our supplier? Accounts payable. What happened to that account? It goes down by $250. Remember, this is the change. Right? So the change is here. The account went down $250, which means we owe $150. If you take $400 minus $250, we still owe $150. That is the ending balance in accounts payable. But if you're looking at the transaction itself, what was the effect of this transaction? Is that we owe $250 less. That's the change, right? And we paid $250, so our cash goes down by $250. Right, and then finally we pay a dividend. Dividend's pretty simple. Company pays cash, so $2,000 goes down. And then what we want to do is anytime you pay a dividend, you just want to record it in the dividends account, and you want to put that in your equity section. And what are dividends doing to your equity? Are they increasing or decreasing your equity? Well, we just need to do a quick review of what a dividend is. What are we doing with the dividend? We earned some money this month, and basically what the company is going to do is going to take some of the earnings, pay it back. So the cash is going down, but where's that cash going? The cash is going to its owners, to the shareholders. And when the company takes cash out of its resources, right? Its resources go down here. to pay its owners. The company doesn't have that $2,000 anymore. The value of the company goes down when you pay a dividend. So anytime you pay a dividend, the dividend account is increasing, so remember that, but the equity is decreasing. So that's why we need to make sure we put a negative number when you have a dividend. Same thing with expenses, right? Anytime you have an expense in here, you want to have a negative. And that also balances, right? Our cash went down 2,000, so here's the equal sign. 2,000 on the left, you need a negative 2,000 on the left. You need to put a negative 2,000 on the right. So that wraps it up. I think some of the takeaways, you're going to have some practice, but some of the things you need to take away is learn about those revenues and expenses and the timing of it. So really study those transactions, especially from about letter E to letter K, maybe letter D too. I think that, or letter E, which was the prepaid insurance transaction, all the way through to about here. Make sure you're clear on why the accounts are where they are when you do your studies for this module. Thanks, everybody.